Unrealized losses at Bank of America just surged to $131 billion. Charles Schwab Bank have seen a 35% decline in deposits as customers pull their money out at a record-breaking pace, and JPMorgan's bond losses have now reached $40 billion. These are just some of the examples of the headwinds that banks are facing right now, and signs of desperation are now starting to show across the entire sector, with many banks putting into place urgent cost-cutting measures. Interest rates have obviously surged over the last couple of years, and this now means that banks can get a higher return on new loans they are writing out, but it also means they pay a higher cost to write this loan, as they have to pay a higher interest rate on their deposits. Now, banks need to be writing out as many new loans as possible at the current high interest rates they can charge, as their current loan book portfolio is heavily weighted towards older loans that were written pre-2022 that are returning a yield that is far below the current market rate for loans, but is also below the current rate they pay on deposits. However, banks are not currently writing out as many loans as they might hope to, and since the end of 2021, banks have started to become more and more strict on who they are willing to write out loans to, tightening up their lending standards. The Senior Loan Officer Opinion Survey on Bank Lending Practices has released new data showing the net percentage of domestic banks that are tightening their standards for commercial and industrial loans. And as you can see from this chart, this percentage has now crossed the 50% mark, which, judging by historic data, has usually not been a good sign of things to come. You can see that we broke 50% at the beginning of 2001, just before a recession and market crash took place, at the end of 2008, which was during the global financial crisis, as well as in 2020, where we had the pandemic and lockdowns. Money is essentially created when banks write new loans out, and the amount of money that is being lent out is heavily correlated with economic growth. Now, tighter credit standards makes it more difficult for firms to obtain financing from these banks, which is bad for economic growth. But it is also bad for the banks as well, because if less new loans are being written out at these higher interest rates, then banks are stuck with a higher portion of their loan book being the older, lower interest rate loans, which are yielding a lower return compared to what they are paying out on their deposits. Banks also currently have large unrealized losses in their bond portfolios, as well as a lot of bad debt on their books. As a result of rising baseline interest rates, bond yields have also surged in the last year or so, which means that the value of the underlying asset has been destroyed. Just taking a look at TLT, a 20-year Treasury bond ETF, we can see that it has lost about 17% in value year to date and about 50% in value since the peak in July 2020. And because of this, many banks with large bond portfolios are now sitting on huge paper losses, which is fine if the banks hold these bonds to maturity. However, if investor and customer confidence does fall due to these large unrealized losses and bank runs do start to take place, then this can lead to the downfall of a bank in the same way that Signature Bank and Silicon Valley banks collapsed early this year. And there is a looming maturity wall of debt that will need refinancing that is coming the bank's way, which includes loans that were given out to commercial real estate firms. And many of these firms are operating in sectors like office buildings and retail shopping centres and have taken massive losses on their portfolio valuations over the past few years. When it comes to corporate debt, US companies are set to have $600 billion in corporate debt maturing for the full year of 2023. However, this number is set to skyrocket in 2024 and again in 2025, where it is expected to grow to more than $1 trillion and remain there for the next few years before rising once again to above $1.25 trillion in 2028. The problem is that these debt loads that American corporations are facing, coupled with the rising costs of new financing compared to several years ago, means that executives need to carefully manage the situation to avoid defaulting on this debt. And analysts do believe that there will be a rise in debt defaults as a consequence of the current economic environment, with many predicting a sea of corporate credit rating downgrades ahead. PNC Financial is one of the latest banks to announce cost-cutting measures to help them get through this new high interest rate environment, which has proven tough for many national and regional banks, and they are going to be laying off 4% of their workforce, which works out to be more than 2,400 employees. Now, this will help PNC Bank to cut their costs by $325 million in 2024 and comes after the bank reported a drop in third quarter profit as a surge in funding costs offset higher interest rates from their assets. And the main driving factor behind this decline in profit is the fall of the net interest income, which is the difference between what the bank earns on loans and what they pay on their deposits. And in other words, the bank is having to pay out drastically more to those who have been depositing money at the bank compared to in the past, but has not yet been able to replicate this increase in what they can charge on loans out. And PNC's net interest income for Q3 fell by 3% on a sequential basis, which is a pretty big deal because of how tight the margins are that banks operate at. They also forecast that this net interest income will drop by a further 1 to 2% from the current levels in the fourth quarter. And Bank of America is another bank who is showing troubling signs, seeing their net interest yield fall to 2.6% from 2.9% just 6 months ago. And as I mentioned at the start, the unrealized losses for Bank of America also rose to $131 billion for this quarter, which is up from $105 billion just 3 months ago. And they also announced that they will be closing 21 branches across the US as a way to cut costs, something that many other banks are starting to do as well, with 54 total branches across a number of different banks, including the likes of Wells Fargo, US Bank and Chase, that are scheduled in the near future across the US. Another worrying trend that is taking place across many US banks right now is the number of outflows being taken out of banks and being moved into other alternatives that offer a much more attractive return. In particular, money market funds or short-term treasury bonds are now offering very attractive yields, pulling money away from the banks. We're seeing the volume of money in bank deposits gradually decline, with the pace of these withdrawals being more extreme in some banks compared to others. At an overall national level, deposits in all commercial banks have fallen by over $800 billion, and this means that for the first time since 1994, the annual percentage change of deposits in all commercial banks has turned negative, now at minus 0.8%. And that means that more money is being taken out of commercial banks compared to the money that is being put into them in the form of deposits. Looking at one of the more extreme examples, Charles Schwab Bank has seen a massive decline in bank deposits over the last 18 months, falling from $452.6 billion in Q1 of 2022 to now being just $290.8 billion in Q3 of 2023. So a lot of this money, as mentioned, is going into money market funds, with this chart here showing that there's been a big surge in inflows into these money market funds, especially since the end of 2022. And this is largely due to investors seeking the attractive yields that these money market funds do offer in the current economic climate. But also the banking collapse crisis that we saw last year, where Silicon Valley Bank and Signature Bank, as well as several others, all collapsed, is also likely to have knocked investor confidence in the banking sector in general, and could also be a contributing factor as to why money is being moved out of banks. And on top of that, when US citizens are facing tougher cost of living conditions and are being forced to spend a higher percentage of their paycheck instead of saving it, this is also going to reduce the amount of cash that is flowing into the banks. This can be seen in the US personal savings rate, which is now far lower than the average it has been in recent history, now at 3.9% compared to above 7% pre-pandemic. Now, all of this does paint a pretty concerning picture for the banking sector. Even though banks are having to pay more nowadays to attract firms and individuals to deposit money with them, they still need this money in order to generate a return when they can loan it out at a higher interest rate. And with many existing loans that were written out not long ago generating a far lower yield than the current rates, and also a lower yield than what the banks are paying out on deposits, banks do need to keep bringing in new money so they can write out new loans at higher interest rates to drive up their net interest income. And without this new money coming in to write new loans, these low yield loans written out before 2022 will be making up a larger percentage of the bank's loan book. So trouble certainly looks to be brewing across the banking sector, but there is also a potential black swan event in the Middle East that is threatening to send shockwaves through the entire energy market, which could send inflation to new highs. I cover this in more detail in my previous video, which you can check out on screen right now. Aside from that, please do leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.